All right, so good afternoon and welcome to the Navigating Entrepreneurship webinar series hosted by Syracuse University's Daniello Institute for Veterans and Military Families. This free monthly event highlights SBA's Community Navigator Pilot Program, or CNPP, and the programs and resources entrepreneurs need to recover, grow, or start a business. If there's a topic you'd like to learn more about in a future webinar training session, please reach out to me via email at ajlalond@syr.edu. I'll put that information in the chat box. As a reminder, this webinar will be recorded, and by continuing to be in the meeting, you are consenting to be recorded. A link to the recording will be posted to the IVMF Community Navigator webpage. We encourage you to use the meeting chat box to ask questions and engage with other participants during the discussion portion of the webinar. Today, you will be hearing from Sherry Falk, the Managing Vice President of Pursuit, and joining Sherry, we also have Cheryl Lickfeld, owner of Optimal CFO LLC and Pursuit Consulting Core member. They will be presenting information about important financial documents and how to utilize them to make informed decisions for your business. If you have any additional follow-up questions for Sherry or Cheryl following the webinar, please email me or either of them, and I'd be happy to connect you. I will now turn it over to Sherry to kick off the webinar.
Thank you, Amanda. Before we jump in, just a few words about Pursuit. We are a community-focused lender serving businesses throughout New York, New Jersey, and Pennsylvania. We are a fit for your business when traditional bank financing is not an option, with many products for your every business need. We have the speed and convenience you have come to expect with post-loan services, including our consulting core, which is a group of consultants with a deep understanding and expertise in areas such as strategic growth, financial management, marketing, web development, and human resource management, to name a few. Cheryl Lickfeld is one of our consulting core members, and she's here today to do a deep dive on decoding your financial statements. Cheryl?
All right, thank you, Sherry and Amanda. So what are we going to cover today? We are going to cover the basically the bread and butter of any business is their financial statements. And so we will cover the components of a balance sheet, your key income statement figures, and we are going to go through some critical measures of financial health. Before I start, I would like to say for all of you veterans out there, thank you for your service to our country. I really appreciate it. So why do you need to understand your financial statements? I'm not going to go through and read all of the slides that I present. Most business owners, they think about their financial statements generally when their tax preparer says, hey, I need your financial statements to do your tax return. And what happens is their tax preparer will say, can you send me your P&L and your balance sheet? And a business owner goes, I don't have that stuff. I haven't done any of that yet. And they or their bookkeeper is trying to cram all their information for the entire year into a bookkeeping system so that they can get that stuff to their tax preparer. Successful businesses, however, they look at their financial statements all year long. That way they know where their business stands, and they can use their financial information to actually make strategic decisions about their business throughout the year. So it isn't just about doing your taxes. It's knowing how your business is doing throughout the year, helping you make adjustments to your business, obtaining lending and taxes. But most business owners focus just on the taxes. So what are your key financial statements? The key financial statements are your balance sheet, your cash flow, and your profit and loss statement. It doesn't matter what business you're in, your business is going to have these three financial statements. Now, again, most business owners, they cram this stuff in at the end of the year. A bookkeeping system, such as QuickBooks, is going to be able to generate these financial statements for you as long as the data that you input into your bookkeeping system is accurate. So we're not going to talk about bookkeeping in this workshop. My assumption is that you have a bookkeeper that is helping you, that can help you create these financial statements. So let's talk a little bit about a balance sheet. So what is a balance sheet? Balance sheet shows how your business is doing at a particular point in time. So when I say a particular point in time, generally what I mean is you could run a balance sheet at the end of the month, at the end of the quarter, or maybe at the end of the year. So at the time that this webinar is being recorded, it's the beginning of July. So you may be looking at your financial statements as of June 30th for the quarter ending June 30th, or maybe you're looking at the half year, the January through June 30th. So you know how your business is done for the first half of the year. So what does a balance sheet do? Well, it basically tracks what your business owns versus what it owes. And we're going to talk about that in the next few slides. So what are assets? Assets are what your business owns. So balance sheet is broken down into different sections, and you'll see all this a few slides in. We're going to go through a case study. So a current asset is cash, which we all love, or any other assets that you have that you expect to turn into cash within a year. So a current asset is a bank account, accounts receivable. So what is accounts receivable? Accounts receivable is if you extend credit to your customers, meaning you do work for a customer and they don't have to pay you right away. That means you've extended credit to your customer and they owe you money. So you have accounts receivable. If you require payment at the time of sale, if you're like in a retail business, generally someone pays you when they take your product, then you're not going to have accounts receivable. Inventory could also be considered a current asset. So if you sell a product, or maybe you're in construction or manufacturing, you may have inventory. If you provide a service like I do, accounting services, I don't have inventory. So not every business is going to have necessarily all of these types of assets, other than you're all going to have a business bank account. So we've talked about current assets. Long-term assets are assets that are not easily converted to cash. So you can't, if you have a building, you own a building, or you own desks, you have an office and you've furnished it with desks and computers, or maybe you have a piece of property on land that you own, or again, maybe you're a manufacturer or a construction company and you have equipment. Those things you generally can't easily turn into cash, meaning you would have to sell those things and it might take a while. So those are what are called long-term assets. So typically, every business typically has some sort of long-term assets, even if it's just maybe computer equipment, because those types of assets generally hang around for longer than 1 year. So we've talked about assets, what your business owns. Now let's talk about liabilities, which are what your business owes. So again, you have current liabilities, like we had current assets. So current liabilities are debts or other obligations that are due within 1 year. So you might have what's called accounts payable. Accounts payable means it's sort of the flip side of the receivables. Accounts payable, you buy something from one of your vendors and your vendor allows you to pay later. So if that is the case, you're going to have accounts payable. Now, if your vendor says, you know what, I need payment when you take whatever I sold you, then you're not going to have accounts payable. You might have a line of credit with your bank. If you have a longer term loan, the portion of your loan that's due within 1 year that's considered a current liability. Or maybe you have business credit cards. All of those things are generally due within a year, and that's why we call them current liabilities. Just like you had long-term assets, you're going to have long-term liabilities. And those are debts and maybe other obligations that are due beyond 12 months. And what typically you would see is if you had, say, a 3 or 5 year term loan, the current portion of that debt is going to be what's due within the next year. And then the longer term portion will be what's due in years 2 through 5. So that's sort of our vocabulary lesson on assets and liabilities. The last component of your balance sheet is your equity. And your equity are really your assets less your liabilities. Sometimes we call equity your net worth. So what goes into your sort of the equity section of your balance sheet? It can be owner investment. So for many small businesses, the owner has to dig into their personal funds to capitalize their business. So you may say, I need to put $10,000 into my business from my own personal savings account. That would be an owner investment. You might also have owner draws, and an owner draw is you taking money out of your business. So your business is doing really well. Depending on how your corporate structure is, you may take a draw out of your business, and that could come out of your equity section. And then the last component really is retained earnings. And that's basically what's left in your business after you've accounted for the profits of your business, any owner investments, and any owner draws. So retained earnings are essentially the net of the profits that you're keeping in your company to capitalize your company for basically future growth. In accounting, there's an equation, and it's called the balance sheet equation. And your balance sheet is always going to balance, hence the name balance sheet. So your assets are always going to equal your liabilities and your equity. And again, this will make more sense when we go through a case study. Sherry, did you have a comment on the balance sheet?
Yes, thank you. Just from a lender's perspective, the balance sheet is an important financial statement. We use the balance sheet to assess financial health, as well as it gives us a view into how the business might have used any loan proceeds, whether it's from their bank or a CDFI, as well as if they are turning a profit, what they're doing with that profit. Are they reinvesting it in the company, or is the owner taking a draw or a distribution? And when we get into the case study, I'm giving you a preview here. Those are important things to look at as far as the financial health of a business.
All right, so we've talked about the balance sheet, and as Sherry mentioned, it's a really important statement, financial statement. It's the one where business owners tend to be a little less sure about because they usually need more help with that one. They're just a little more hesitant when it comes to creating a balance sheet, but that's where your bookkeeping system comes into place. If you have a competent bookkeeper, they'll be able to help you manage your books and create this balance sheet. So the next statement we're going to talk about is the profit and loss statement, which is probably the one that you're saying, all right, this one I know. So the P&L, profit and loss statement, is also called an income statement. I'm going to use those kind of interchangeably. The P&L is, as you know, summarizes your business revenues and your expenses over a period of time. So what happens is you are going to record all your transactions in your business, and your P&L you can run for a month, or a quarter or a year. So again, we're at the beginning of July. So you might have just received or created a P&L for the first 6 months of the year, January through June 30th. That's for a time period. A balance sheet, remember, is a specific sort of snapshot in time. Your P&L records everything over a time period. That's really the difference between a balance sheet and a P&L. And I hope that becomes clearer when we go through the case study. Your P&L, you use that to really evaluate your profitability, and more importantly, you can see trends in your business. And again, revenue minus expense equals your net income. That's the essential formula for your P&L. The cash flow statement tracks your business cash inflows and outflows also for a time period. So again, it could be for a month, it could be for a quarter, could be for the year. It's sort of the same concept as your profit and loss statement. One of the things that I want to really drive home is that your net income does not equal your cash flow. Many business owners get confused and they say, well, I looked at my profit and loss statement and I have great net income, but I look at my bank account and I don't know where my money is. So that is always a concern for business owners. And when we look at the case study, I'm going to show you why that's not the case. So we're going to do a little poll here. If you have a business, how often do you review your financial statements, or how often do you think you should review your financial statements? So let's see. I hope, let me get rid of that. Oh, hold on, a little glitch here. There it goes. So best practice is to do a monthly review of your financial statements. Again, a lot of businesses, they wait until they are like basically dragged kicking and screaming to create their financial statements for their tax preparer. But really, in order to manage your business, you have monthly financial statements. You really want to do a monthly review. The reason why is you can compare how things are actually happening in your business to what you expected to happen in your business. And it enables you to pivot your business based on this financial information. You're not just sort of flying blind in the dark going, well, I hope I'm doing okay. You can really make those strategic business decisions. So now we're going to get into that case study I talked about. This is not a real person. I created this sort of fictitious company, but it'll give you a flavor of what we're talking about here. So Deb owns DW Marketing Agency. And when we originally did this presentation in the beginning of 2022, that's why the years are 2019, 2020, 2021. So let's just pretend we're going back in time to the beginning of 2022. So Deb started her agency in 2019, and she hired a full-time employee in 2020. And then in 2021, she hired a second full-time employee, and she took out a loan because she needed some specialized equipment to expand her business. So Deb has a bookkeeper. She has a part-time consultant who prepares her financial statements for her. She gives her a balance sheet and an income statement at the end of every month. But Deb, like a lot of business owners out there, is so busy trying to manage her business and and get new clients, that she really hasn't looked at her financial statements. But under the terms of her loan, Deb is required to give her lender her balance sheet and income statement at the end of the year. So now her lender has come back and her lender has some questions for her. So Deb is like, oh my God, now what do I do? I don't know how to answer these questions. So Deb contacts her bookkeeper and says, hey, can you walk me through these so that I understand them, so that I can ask or answer these questions? So we're going to kind of go through and do a little bit of analysis of Deb's financial statements so that she can have a conversation with her lender. So here's that balance sheet. And you're like, oh my gosh, this is so much information. And you know what? It is a lot of information. We're going to pick out some key components of this so that you can start to think about your own business and analyzing your own financial statements. So we're back to that balance sheet equation. Assets equals liabilities plus owner's equity. And you can see I've highlighted on the right-hand side of the screen the total assets of the business, the total liabilities, the total equity. So you see assets equal 53,000, liabilities 46,000, owner's equity 7,000. So this is the essential balance sheet equation. If you're using a bookkeeping program like QuickBooks, it will not let you have an out of balance balance sheet. If you're trying to create one using Excel or pen and paper, this is an important thing that you have to remember, that this thing has to balance. And again, we talked about all those different sort of sections of the balance sheet. We talked about current assets and long-term assets and current liabilities and long-term liabilities. You can see that this balance sheet is broken out into all those different components. Now, your balance sheet for your business may not have all of these components, or it may have additional components that aren't shown in our case study. For example, again, if you sell a product, you may have in your asset section inventory. So if you're a contractor, you may have equipment, like maybe you have a bulldozer, let's say. You're going to have a big section in your fixed assets section. So your balance sheet is going to be reflective of the assets and liabilities of your business. Now you'll see that I've put up basically a 2-year comparison balance sheet, 2021 versus 2020. And it's always helpful to have at least 2 years, if not more, of information so that you can start analyzing trends in your business. And we'll go through that. So what are some critical balance sheet calculations? These are calculations that you can easily do with the with your balance sheet that will help you kind of give you you can kind of do a thumb, like, all right, how am I doing on certain criteria? And there are a lot of calculations that you can do. I've picked out 3, and these are sort of universal calculations that all businesses can do. And lenders will be looking at these particular calculations. And if you had an investor, and I'm not talking, you're going to be selling stock in your company. Maybe someday you will, but you may ask friends and family to invest in your business. And a savvy investor is going to start looking at these types of calculations. So let's go through some of them. So what is net working capital? So net working capital is current assets less your current liabilities. And why would you calculate net working capital? Well, it's used to measure your company's ability to fund its current operations and invest in future growth. So what does that mean? It means, can you basically pay your bills with the current assets that you have? Current assets are assets that are cash or can be easily converted to cash. within a year. And your current liabilities are liabilities that are due within a year. So basically, can you pay your bills? That's what this net working capital is trying to determine. So we'll go back to Deb's balance sheet. And this is where having, again, multiple years to compare, you can start seeing the trends. So I'm not going to go through, you can see the highlighted portions. We're going to be picking out the total current assets and the total current liabilities and doing this calculation for 2021 and 2020. So to make it easier, we're not looking at, prior years, but if you had a business and you were in business for 5 years, you could look at the past 5 years balance sheet and you could do this calculation. It's a simple calculation that you can see. And you could see the trend of over the last 5 years. How is my net working capital trending? So in Deb's case, in 2021, her net working capital is about $4,000. And in 2020, it was about $16,000. So right now I'm going to focus on the calculations and then we'll analyze them in a few slides. So that's how you calculate net working capital. Your current ratio is a very similar calculation to the working capital, except it gives you a ratio versus a fixed dollar amount. So you're still going to be using your current assets and your current liabilities, except you're going to be dividing your current assets or your current assets divided by your current liabilities to come up with a ratio. And again, it's another measure of your company's liquidity. And it really is meant to determine whether or not your company has the ability to pay its short-term obligations, its bills. And the general rule of thumb is if it's above 1, then yes, you can pay your bills. And if it's below 1, then you're probably struggling with cash and you're probably getting calls from your vendors and you're saying, all right, this guy called me a couple times, so I'll pay him and we'll hold off on paying this other guy. If that's where you are in your business, your current ratio is probably below 1. And so for Deb's business, again, I'm pulling up her balance sheet. We're using the same figures that we used in the working capital calculation, current assets, current liabilities, except we're doing this division. So in 2021, Deb's current ratio was 1.11, and in 2020 was 1.99. So again, I keep saying, if you keep a spreadsheet and you have multiple years, you can sort of keep a running tally of these ratios and you can see the trends over time. And the last ratio that we're going to focus on for your balance sheet is your debt to asset ratio. And that is taking not just your current liabilities and your current assets, but it's taking your total liabilities. So your current plus your long-term liabilities, your current and your long-term assets, combining those together, your total liabilities divided by your total assets to get your debt to asset ratio. And that's really giving you an indication of how much of your business assets were purchased through debt rather than equity. And equity is how much money you've put into the business or how much retained earnings or your retained profits you're able to use to purchase assets versus using debt. So if your debt to asset ratio is over 1, it's considered high, and you have more debt than assets. If it's 0.6 and higher, it's still pretty high and you may have trouble borrowing money. If it's 0.4 and lower, it's probably in line. You've got some debt, but nothing that you can't service, on a monthly basis. So That's your debt to asset ratio. So we've done all these calculations and you're like, oh my gosh, I don't understand any of it. Well, you're going to, again, remember, you're going to get this, recording. You'll be able to go through it and write down a little cheat sheet to yourself of all these formulas. So, Deb's debt to asset ratio in 2021 is 0.86 and in 2020 is 0.48. And again, you're using your total assets your total liabilities divided by your total assets to come up with that debt to asset ratio. So now let's sort of put all that together. We've just done these 3 calculations for 2021 and we've done them for 2020. And now we kind of want to look at them as a whole and say, what's going on? Is my business in a better position in 2021 than it was in 2020? Is it in a worse position? Am I doing about the same? What's going on? So in Deb's business, you can see these are the figures that we calculated. So I think we're gonna, so we're gonna do a poll. And based on these figures, I want you to tell me whether you think Deb's business is doing better in 2021 or worse, better in 2021 versus 2020 or worse in 2021 than 2020. So give me sort of, is her balance sheet more financially sound? Which year, 2021 or 2020? What are people thinking here? Oops. All right, so everyone pretty much got that one. Oh, every time I look at the chat room, it doesn't want it there. So definitely her business was more financially sound based on these metrics in 2020 than in 2021. 2021 are definitely showing red flags because her net working capital dollar amount is lower in 2021. Her current ratio, which is again an indication of whether she can pay her bills timely, is also down, and her debt to asset ratio is up in 2021. So, she may not be able to take on more debt. Another thing that you can do when you're looking at your balance sheet, which I like personally to do, is something simple called variance analysis. And that's really just taking what your account balances are this year and comparing them to last year. And you can, again, keep going down and down and down into, drill down and down into prior years. But you can do a variance analysis, both a dollar variance between years or a percentage variance. And a variance analysis will help you identify trends in your business and potentially trouble spots. So when we're looking at Deb, you can look at that right-hand column for variance, and you can see her cash is down from 2020 to 2021. Her accounts receivable is up, meaning that her customers owe her more money. Her fixed asset, she bought computer and office equipment. So that balance is up, but that's explainable. She bought the equipment, so you would expect that balance would be more in 2021. Her current liabilities are up in 2021, which means that she's getting behind in her bills. Her long-term debt is up, but again, we know she took out a loan to finance that new equipment. Her draws are up. She took out more money. She took more money out of her business in 2021 than she did in 2020. And her net income is up in 2021 versus 2020. So all of those things you can say, all right, I see all these variances. Now you can do a deeper dive into why those variances exist. And that's what we'll start doing. One thing I want to talk about just a little bit more about accounts receivable and accounts payable. So we talked right at the beginning, and I said accounts receivable is money that your customers owe you. You've extended credit to your customers. Accounts payable is money that you owe your vendors. They've basically extended credit to you. So it's very important, if you have accounts receivable or accounts payable, that you have some sort of report that shows you the breakdown, the detail of what's in those balances. If you use a program like QuickBooks, you'd think I like Headstock and QuickBooks. I really don't, but it's the most popular bookkeeping program out there. So if you're using a program like QuickBooks, you're going to be able to generate very easily a accounts receivable report and an accounts payable report. What you want to do is you want to create what's called an aging report. So an aging report will show you how old your accounts receivable and your accounts payable are. So, for example, if you have a customer that owes you $10,000 and you say, I'll give you 15 days to pay it. And you look at your accounts receivable report and they haven't paid it and it's now 30 days, that thing is going to show in an aging bucket where you're going to be on the phone to that customer and say, hey, you know what, your account is past due. I need you to, send me a check. And the same thing with your accounts payable. If your accounts payable where you haven't been paying your vendors, that's going to show you that that your bills are overdue. And you might be the one getting a phone call from your vendor, and your vendor might be saying, hey, you gotta throw me some money here, or I'm not going to be able to keep providing you whatever they're providing you. So if they're providing you with product that you're then reselling in your store, you're going to be in trouble. So you really want to be looking at your accounts receivable and your accounts payable aging reports so that you can really manage your working capital needs, because obviously you need to get your customers to pay you more quickly so that you can pay your vendors and not ruin those relationships. And remember way back when I was talking about the cash flow statement and I said your net income does not equal your cash flow? This is the main reason why. You may have net income that looks pretty good, but if your customers aren't paying you, all your cash is going to be tied up in your accounts receivable. So it may look like I have a really great P&L, but you have no money in the bank. And that's really, I think, one of the major stumbling blocks for a lot of businesses, because they're just focused solely on that P&L. And then they're looking at their checkbook going, I don't know where my money went. That's when you have to be looking at your accounts receivable and your accounts payable. Sherry, I think this is another spot that maybe you wanted to make some comments.
Yes, thanks, Cheryl. I can't emphasize enough, the points that Cheryl just walked us through. From a lender's perspective, when we're looking at that P&L, and all your financial statements, looking at the way any business owner is managing their financials and using statements, hopefully on a monthly basis, to inform business decisions. For the accounts receivable portion, you have to make sure your clients are paying within the agreed upon time, because if it lags too long, that outlook from a lender's perspective, you as a prospective borrower, becomes a little bit more risky to a lender. Because although you're getting contracts, you're not getting paid on the contracts, and therefore the means of repayment isn't necessarily there yet, right? Because you're not collecting that on that accounts receivable. And then on the other side, accounts payable, looking at the aging report, and the better it looks, the faster you're getting back to your vendors and paying your own obligations, the stronger you look from a financial management and financial statement outlook, if and when you're ever looking to get financing. So just wanted to add a few notes from a lender's perspective on this point.
Okay. All right, so now let's go into the profit and loss. So the last several slides have been focused on balance sheet and balance sheet ratios and metrics. Now let's turn our table to, or turn our attention to the profit and loss statement. And again, this is probably one that if you're in business is more familiar to you. So your profit and loss or your income statement basically calculates your revenues less your expenses to come down to your net income. In Deb's case, her net income for 2021 is about 110,000 as compared to about 86,000 in 2020. So when you're looking at this, you think, hey, you know what? She's doing pretty well. Her net income is up. And that may be the case, but we're going to do a little deeper dive to see if there are any sort of trouble spots here. So let's talk about some P&L calculations that we can do. There are, and again, the same as with balance sheet, there are a lot of different calculations that you can do with your income statement, your profit and loss statement. And we're going to focus on three that are, again, pretty universal to almost all businesses. And again, as we talked about in the balance sheet, lenders, investors, they'll be doing these types of calculations to see, how financially strong and worthy you are of a loan or an investment. So we're going to go through sales growth, and we're going to calculate a gross profit margin and a net profit margin. So we're going to have more of these formulas. And again, don't freak out. You're going to get this presentation. So you'll be able to go back and write these formulas down. So this is like a scary formula, but actually when you break it down, it's pretty easy. We're basically calculating the percentage growth from the prior year to the current year of sales. So this is how you do it. I'm not going to go through all of it. You'll see the next slide where we'll actually do the calculation. But basically, we're going to determine whether the sales increased or decreased over a period of time. So we're back at Deb's income statement. And again, I always say, do at least a 2-year comparison. You kind of need that to do this calculation. But it's always helpful. I'm beating a dead horse here, but go out as many years as you can to see the trends. So, and again, we're gonna do the calculation here, and then in a few slides, we're gonna kind of analyze them all together. So here, Deb had 346,000 and change in sales in 2021, 253 in 2020. So she's almost at a 37% increase in her revenues. So it's like, hey, that looks pretty good from this perspective. So now let's see what gross profit margin. Now, gross profit is a formula that is calculated as your sales less your cost of goods sold. And in the next slide, I'll explain a little bit more about what cost of goods sold means. But basically, your gross profit margin is going to tell you how profitable your business is at its core activities. So if you are Deb is she's a marketing company. So how good is she at generating sales in marketing? How how good is she at managing the expenses that go along with generating those sales? And again, we'll talk about cost of goods sold in a minute. So basically, gross profit is going to show you how much profit you have left over to cover any other operating expenses or what's called overhead. The higher the percentage of your gross profit margin, the better it is, because it just leaves you more room to have more net income down the line. So let's talk just a little bit about cost of goods sold. So cost of goods sold is the amount that your business pays as a cost that's directly related to the sale of your products and or services. So for example, in Deb's case, she does like media placement. Well, so she has, say, $10,000 in sales, but she's got to pay a radio station $8,000 to place that ad. So the $8,000 is her cost of goods sold. It also, cost of goods sold can include the labor that goes into creating your product or service. So Deb hired an employee who works directly on customer accounts. So their wages and benefits and everything else are included in cost of goods sold. So for a service company, it's sort of more, I think it's hard for people to conceptualize cost of goods sold. Usually someone who has a product, it's like super easy to understand, because you buy a widget for wholesale for $5 and you sell that widget to the public for $15. That $5 that you bought at wholesale, that's your cost of goods sold. So that's sort of the concept here of cost of goods sold. If you're a retailer, the cost of goods sold is the cost of the product you sell. And if you're a contractor or a service provider, your cost of goods sold is going to be like the cost of materials and labor on a project. So back to Deb, she's calculated, her bookkeeper has calculated her cost of goods sold for her. So we're able to pull from her P&L her gross profit margin. So we're going to take her gross profit, which is her income, her income less her cost of goods sold. That's her gross profit, divided by the sales times 100, comes up with a gross profit margin percentage. So in 2021, that calculation is 68.7%. In 2020, the calculation is 72.6%. So this is a perfect example of why it's beneficial to calculate a percentage sometimes versus just an absolute dollar amount. Because in this example, Deb's gross profit margin dollars increased from 2020 to 2021, but her gross profit margin percentage actually decreased from 2020 to 2021. So it's something we'll explore later, in the case study. But this is, like I said, a really good example of why you don't always want to just use dollar amounts. You sometimes want to use percentages. And then we're going to calculate net profit margin. And net profit margin is really, you're going to take your bottom line after all your expenses, calculate your net profit, divide that by your top line or your sales times 100, and that will give you your net profit margin. So it's basically the net profit margin is the calculation of the percentage of sales remaining after all your expenses of your company have been paid. And so for Deb, her net profit margin for 2021 is 31.8, 2020 is 34.1. And again, the percentage has gone down, even though the net income dollar amount has gone up. So now we're doing this. Okay, now we've got a snapshot. We've got these 3 metrics that we've calculated. We've got our 2 years, and we want to say, okay, what, now, what does it look like for Deb? What sort of, how on track is she? What is her, what are the trends in her company? So based on the three metrics that we've calculated, which profit and loss statement do you think is more financially sound, 2021 or 2020? Let me go back. So based on these, which one do you think is more financially sound? Give everyone sort of a second. So let's go through. Oh. So getting a little ahead of myself here. So here, even though her sales growth is great, she, rocked her sales growth 37% higher in 2021. Her gross profit margin, net profit margins are down a little bit between 2020 and 2021. So there may be some issues that she can work on here. Just like we did the balance sheet, we'll also do a P&L variance. And again, you can do dollar and or percentage. And it's really to identify trends and any potential trouble spots. So for Deb, her income is up. We know that. Her gross profit is up. Her net income is up. So all of those, if you're just looking at dollar amounts, they're all trending in the right direction. But we know from our previous calculations of the ratios and other metrics that we did, that maybe there are some trouble spots here. So, you can go through and you can say which one of these overhead expenses, overhead expenses might be up. One that you can pick out right away is her sort of towards the bottom, wages, non-project related. So those wages are up about 13,000 between 2020 and 2021. So what does that mean? It means she's hired people, but maybe they're not quite busy enough. She has people that she's paying, but they're not necessarily working on client business. So one of the things Deb might want to do is say, oh, I really need to look at this. Is it because I had a newer person and they were being trained and now they're up to speed? Or is it just, or is it that, they're not as efficient when they're working as they should be? It's just a way for her to start digging more deeply into her financial statements and her business. Another thing that is very helpful is if you start analyzing your gross profit margin in more detail. And what I mean by that is you may have, as Deb does, several sort of lines of revenue. She has advertising income, event income, video production, media planning, and print production. So she's broken her financial statements into those different buckets. So she knows, all right, how much income I have in those buckets, what the cost of goods sold are in those buckets. So she can figure out her gross profit based on all of those different buckets and not just the total for her business as a whole. And this is really important because she can use these gross profit margins and say, well, what's performing better in my business? Which segment of my business is performing the best? And maybe I should focus my marketing efforts on those segments of my business. If I make more money in a certain area, then that's probably where I should be focusing and saying, hey, I'm the expert in this area. So for Deb, her focus, she said, you know what, I want to focus on video production. That's what she decided in 2020. She said, I'm going to focus on video production. And when you look at her video production, gross profit percentage, you see that between 2020 and 2021, it went way down. So she really needs to determine why that is. It could be a pricing issue. Maybe she's priced her product or her service too low. Or it could be a labor issue. Maybe it's so labor intensive that you just can't, it costs you so much in labor to produce these videos, and you're just not able to charge. You would basically price yourself out of the market. Who knows? But she can start looking at this, at that detail, because she knows using the gross profit margin, that's a trouble spot for her. If she didn't have that, she would just have this sort of mix of business, and she wouldn't know really where to focus her efforts. So we're going to go and do another quick poll. So based on her gross profit percentages, which segment of Deb's business performed the best in 2021? We're going to go back to the screen. So which one do you think performed the best? So for Deb, media planning. Media planning has the highest gross profit percentage of her business. So now Deb's thinking, maybe media planning is where I should be focusing more of my time. So now we've got all our financial statement calculations that we've just done, and we're not going to go through them again. We've gone through them several times now, but now you can see a full snapshot of Deb's business, and you can see, yeah, you know what? There are some troubling trends here. Even though my net income's up, even though my sales are up, even though the dollar amount of my gross margin is up, my percentages are showing that, you know what? Maybe I need to do some tweaks in my business. So here we are, Deb's balance sheet and P&L. And what I would say is, when you're looking at your financial statements, what you're really trying to do is determine, like, you're telling the story of your business. That's really what your financials are doing. So in Deb's case, again, her 2021 net income is $110,000 versus $86,000 in 2020. So she made more money, bottom line. That's a definite plus. But the ratios we calculated show that her 2020 balance sheet was more financially sound than 2021. So you may be thinking to yourself, I still don't understand. Why is this? Why would a business that has a more profitable income have a weaker balance sheet? Well, in this case, if you look at on her balance sheet, Deb took $120,000 in draws in 2021 versus $80,000 in 2020. So she increased her distributions, and those distributions decreased her equity. She essentially withdrew in 2021 more of the business, more than actually the business made in profit. Whereas in 2020, she left some of the profit in the business as working capital. So despite the fact that her income was improved, she really made her business weaker by taking so much out of the business. And a lender or an investor may look at this and say, all right, because she took out more distributions, she now had to take on more debt. She's not paying her accounts payable timely. She's got more credit card debt. So a lender is going to say, am I going to lend money just for this business owner to take distributions? It would be a definite red flag. And even if Deb didn't have a loan, say you're like, you know what, I am not getting a loan. You still, if you take more business or take more equity out of your business, than you make, your accounts payable is going to suffer. You're going to end up putting money on credit cards, and your business is ultimately not going to be able to pay its bills. Your vendors are going to say, you're cut off. I want payment up front, and you're going to be scrambling. So in this case, Deb would definitely want to be more careful about how much money she takes out of her business, just so that her business survives in the future and that she is able to, grow her business like she wants to. And Sherry, I know you wanted to make another last comment here.
Well said, Cheryl. Not much to add in you wrapping up all the different calculations you walked us through, the stories of what Deb's financials were telling us from a lender's perspective in comparing the P&L and balance sheet year over year, from whether it's an investor or a lender's perspective, looking at what are the dollars that this business owner is looking for. What is that going to actually fund, right? Is it going to fund growth, or is it going to fund some of these higher expenses, higher wages, higher distributions? So to Cheryl's point, use your financial statements to both look at trends in your business in order to keep on top of and inform your business decisions to, keep sustaining and growing your business, and then reevaluating what worked last year. Is that still working this year? Because there's so many different things that go into, to Cheryl's point, is it a pricing thing? Is it a labor thing? But you don't know any of these things until you have the financials in front of you. So thank you, Cheryl, for your expertise today.
You're welcome. And Sherry, there's your contact information.
Yeah, so that wraps the end of the webinar. As Amanda pointed out at the top, should you have any questions for Cheryl, Amanda, or me, you can get a hold of us. Amanda's contacts in the chat. You can reach me and Cheryl through my phone number here or email address. We're always happy to help anybody with any of the information provided today. And then you can access this through the channel that Amanda will send. And then also we have a lot more resources and articles that give you actionable advice on pursuitlending.com. So we encourage everybody to keep in touch, and we're always here as a resource to you. Thank you, Amanda. And thank you, Cheryl.
Yep, thank you.
Yes, thank you both, Sherry and Cheryl, for presenting today. We really appreciate it. And thank you everyone for attending our webinar. And I hope everyone has a great afternoon. Thank you for coming to our webinar.
Thanks, everybody.
Thank you.